David, you've called this one unloved. I'd call it hated. This move from the bottom all the way up and through this morning. What's your take at the moment?
Well, it's interesting, the definition between unloved and hated. I guess the indifference is what Dante said is really the opposite of unloved. But the idea of portfolio managers, they certainly welcome the idea of a higher market. Most fund managers are long biased, long tilted, whether they're a long-only fund, mutual fund, or whether they're a hedge fund, they tend to have a long bias. So the rising market has certainly been welcome. And it's been unloved. You could argue your term's hated because most fund managers haven't been positioned to participate fully in this recovery. I will certainly say, as a strategist, I've been surprised at the magnitude and the persistence of the 35% move in the S&P 500. Of course, as you've talked about, no doubt, and others, the rally has been so driven by a relatively narrow group of stocks, primarily in technology, that has helped lift the indexes. But the underlying typical stock actually hasn't necessarily participated as much as the headline index would show. And so that's an issue that has been much discussion with clients and portfolio managers now, because does one continue to own the leaders of the market, the top 5 concentration stocks? Never been this concentrated in history. Even back in the tech bubble of 2000, the top 5 stocks then were like 18%. Now we're talking at 20%. 1/5 of the market is dominated, controlled, or represented by just 5 companies. So we know the drivers diagnostically, and then looking forward, the idea of the cyclical recovery, which has certainly been a focus in the last couple of weeks, in the last couple of days, frankly. But the persistence of that, I would say, is I'm less confident about that. Would focus more strategically on some of the market leaders, and whether that's in technology, whether there's more secular growth and stronger balance sheets. Some of those characteristics, in my view, are more sustainable in terms of their drivers.
Well, David, let's talk about that. It's important. The reopening rotation has taken place over the last couple of weeks. What is it about that rotation that you don't think is durable? What is it about it that you don't think is sustainable?
So the key issue is the rehiring rate in the United States. The idea is, tragically, we have almost 40 million people filed for unemployment, initial unemployment, over the last 9 weeks. And how quickly, hopefully it will be quickly, but how quickly and how many, what percentage of those individuals who have been laid off or furloughed will be rehired by their employers? A basic assumption a lot of people have been making, around 80%, and that will drive the economic activity. And as people leave shelter in place or begin to reopen some of these state economies, does that lead to more sustainability? Well, you've had a big move already in a lot of these companies, and I would answer the question as follows. I prefer and recommend that you own domestically facing goods producers as contrasted with services providers. So every company in the country is classified as either a goods producer or a services provider. And the lessons from China is that the leading edge of the recovery or the restart of the economy, Jonathan, is led by is led by the industrials, not the consumer. So we want to own U.S. companies that are more business to business, goods producing. Those would be a lot of companies in the chemical business, chemical space, some machinery, some aerospace. That would be your trade, if you will, your tactical trade, but strategically still looking for stronger balance sheets and technology to be offering better returns over time.
What's interesting here, David Kostin, is small caps. Chris Verone over Strategist has a brilliant note this morning noticing the elevation of small caps, but he asks the Goldman Sachs-like question of, do they on an absolute basis advance, and can they even advance on a relative basis versus large caps? Do you have an affinity for small caps right now?
I do not, and the reason for that is strictly on the balance sheet. We know the singular risk in this economic dislocation has been a collapse in revenues here in the second quarter, as much of the country was was at home, and just there wasn't a lot of activity. And therefore, liquidity and balance sheet strength were key. So the Fed obviously came in with many programs in terms of the support in the commercial paper market or in the IG market, in fact, in some of the fallen angels in the high yield market. But still, the liquidity and solvency are critical issues in the uncertain path of recovery, and therefore would rather own companies with stronger balance sheets, which characteristically are larger companies as contrasted with smaller companies, which typically have more leverage and just they're less flexibility on the financing side.
David, perhaps the theme of the year is growing disparity, whether it's in incomes, low and high income households, whether it's the companies that are doing well in the stock market or not doing well. And then the latest from the U.S. Budget Department coming out and showing that the economy is not going to recover in the United States for nearly a decade from the shock that it's just experienced. How long can the U.S. equity market as a collective remain divorced from this underlying economic reality as put out there by the United States?
As you said, it is the critical question for both society and for the investor community about what appears to be clear dislocation between the path of what the economy is sort of going through and where the equity markets, which we know a couple things. Number one, the equity market is a discounting mechanism, so it looks out into the future and brings this forward. So it is clearly anticipating a steady restart, basically implying that there's not a lot of dislocation, whether that's through the, second viral wave, various other, just it's going to basically be a steady normalization of the process, and that is the first, argument and why the equity market has been rising so much. But we have to understand as well that the stock market is not a pure reflection of the economy. It's definitely much more skewed towards stronger balance sheet companies, for example. It's skewed towards businesses which are more in technology. It's much less in the housing market than the rest of the economy. So they're not purely representative of one or the other. But ultimately there is, you mentioned the word divorce, there has to be some linkage between the earnings of a company and the overall size of the economy. And the economy is basically driving revenues, and the expectation is business is getting better. You didn't quite get that, frankly, in the commentary from corporate management in the first quarter conference calls that just ended. They were generally more subdued, lots of concerns about the pace of restart. And so it would suggest to me the S&P 500 at these levels is trading at a higher level than I have at the end of the year, right about, roughly the same level, but 3,000 is a target at the end of the year. And if I think about the risks around this, you're looking at modest upside risk, maybe 5% opportunity, and 5% puts you at 3,200, and that's basically because positioning is light, neutral to light, and that's where it's been hovering. So investors have not been super embracing, using, Jonathan, your terminology, it's a hated rally. They've not participated. On the other hand, you have the concerns about the pace of the restart, and can you get all these people back so you have a sustainable recovery? And the market, therefore, puts down at like 2750 would be 10%. And it's asymmetrical skew, somewhat to the downside from the risk point of view.